Assuming Elon Musk succeeds in reducing accidents by 50% compared to human drivers, could auto insurance rates drop accordingly, reflecting the reduced underwriting risk? This could potentially have a significant adverse impact on insurance companies like Geico, affecting their revenues, float, and possibly even their margins. Let's take the extreme scenario where, for some outlandish reason, there are only 3 accidents across the United States next year. Anything that cuts down accidents will naturally lower costs. While such a drastic reduction might seem far-fetched, any significant drop in accidents would undeniably show up in the data, and this would, in turn, drive down insurance prices. Now let's dive into a thought-provoking topic that has been making waves in the financial world. Warren Buffett, the legendary investor and leader of Berkshire Hathaway, recently made some eye-opening comments that could have profound implications for Tesla and its stock. Buffett's statements, especially his thoughts on Tesla's self-driving technology, have left many investors and analysts in a state of contemplation. His predictions suggest that Tesla's technology, which could reduce accidents by a massive 50%, might be beneficial for public safety, but it could also cause substantial disruption in the car insurance industry. Fewer accidents would mean a reduced need for insurance, resulting in shrinking volumes for insurance companies, a sector that has historically thrived on risk. Buffett, in his signature style, acknowledged that while this would be challenging for the insurance industry, it would be a net positive for society. But just when you think the conversation has reached its peak, Elon Musk, ever the unpredictable visionary, stepped in with a tweet suggesting that Buffett might want to reconsider and perhaps buy some Tesla stock. Musk's intervention in this dialogue turned what could have been a dry debate into a lively stock tip. However, before you rush to buy Tesla shares, it's worth noting that several industry giants like GM and Uber have previously tried and failed to make a successful entry into the insurance business, primarily due to issues in accurately pricing risks, which led to substantial financial losses. Speaking of Tesla, it's clear that the company is not just in the business of building electric vehicles. They are actively collecting and analyzing data at an unprecedented scale. From tracking driving speeds to monitoring braking patterns when a squirrel unexpectedly dashes across the road, Tesla is accumulating a wealth of information that could one day radically change the way we approach car insurance. The challenge with insurance, as Buffett points out, is that it often looks deceptively simple from the outside. You collect premiums up front, and then the real test comes when it's time to settle claims. But the real difficulty lies in accurately assessing the risks and pricing policies accordingly. As Musk highlighted, reducing accidents by 50% would certainly be a boom for society, but could be detrimental to the volume of business traditional insurance companies can generate. Tesla, however, isn't just content with reducing accidents. They are envisioning a future where their cars don't just avoid squirrels. They could also help lower your insurance premiums by bundling the self-driving technology with your insurance coverage. The prospect of lower costs and improved safety could make Tesla a major disruptor in the insurance space, although this doesn't bode well for traditional insurers who might find themselves struggling to keep up with the changes. A major challenge that Tesla faces, however, is that while their technology may reduce the number of accidents, the accidents that do occur may be more expensive to repair due to the high-tech components in their vehicles. These advanced systems and sensors, though they make Tesla cars smarter, come with high repair costs. So while fewer accidents might occur, the cost per incident could rise, potentially offsetting the savings that would normally come with lower insurance premiums. Now let's take a deeper dive into Tesla's plans for revolutionizing the insurance industry. Imagine a world where your car manufacturer also handles your insurance. This could not only change the way car insurance works, but also alter the entire distribution of risk and responsibility between the car owner and the car manufacturer. Tesla might be positioning itself to take on more of this burden, shifting part of the responsibility onto the shoulders of the companies that create the cars, thereby disrupting the traditional insurance model. This shift could cause ripples in the entire automotive industry, forcing traditional insurers to recalibrate their strategies to stay relevant. The landscape of car insurance might evolve in ways we can't yet fully anticipate. As Tesla continues to push forward with its self-driving technology and data collection, The insurance industry might have no choice but to adapt to these new realities. And with this shift, Tesla could change not only how we drive, but also how we insure our vehicles. Speaking of Tesla's vehicles, they are designed to be as smart as they are aesthetically pleasing. A big part of this intelligence lies in Tesla's approach to car repairs. Instead of a complicated, intricate system of parts that are difficult and costly to replace, Tesla's design philosophy centers on modular components that can be swapped out and repaired easily. This makes repairs less expensive than anticipated. Instead of thinking you'll need a small fortune to get your Tesla fixed, you may find that the cost of repairs is actually quite reasonable, especially when compared to traditional vehicles. Now, let's look at the numbers. While the cost of individual repairs may not skyrocket as initially feared, the real savings come from reducing the frequency of repairs altogether. With fewer accidents, thanks to smarter driving systems, the overall cost of repairs could decrease significantly over time. This represents a win-win scenario for both Tesla owners and society, as it results in lower repair bills and a reduced environmental impact due to fewer accidents. To put it into perspective, Tesla recently hit a major milestone. It took over 3 years to reach 1 billion full self-driving (FSD) miles, but it will take less than 3 months to reach 2 billion. Tesla's fleet is accumulating miles at an exponential rate, and the results speak for themselves. As of now, FSD is preventing about 7 crashes a day, and statistical analysis shows that FSD could be saving 1 life per week. This is a staggering figure that underscores just how much impact Tesla's technology could have on public safety. But the impact doesn't stop there. Tesla's journey is far from over, and every new mile driven brings them closer to the future of fully autonomous vehicles. Tesla's full self-driving technology is not just changing the way we think about driving. It's actively saving lives and preventing accidents on a daily basis. With over 1.5 billion miles already under its belt, Tesla is on the cusp of reshaping the future of transportation. This is where things get really exciting. Tesla's journey isn't just about building cars. It's about transforming entire industries, including car insurance. As Tesla continues to make strides with its self-driving technology and data collection, it may very well be positioning itself to not just revolutionize the car market, but to disrupt the insurance industry as well. The implications of this are massive, and we can't help but wonder what the future holds for traditional insurance companies in a world where Tesla leads the way. Now, speaking of the stock market, it's worth noting that Warren Buffett has long been cautious when it comes to tech stocks. However, Elon Musk recently suggested that Buffett might want to consider adding Tesla to his portfolio. This could be an interesting strategic move for Buffett, especially given the growing shift toward electric vehicles and renewable energy. Musk's suggestion wasn't just about buying Tesla for the sake of it. He proposed that Buffett might want to consider a smaller stake in Tesla as a hedge against his oil and gas holdings, as well as other investments that could face challenges in the coming years. In the past, Buffett was hesitant to invest in Apple, preferring companies that fit within his circle of competence. But over time, the allure of Apple's cash reserves and buyback strategy won him over. Today, we might be seeing a similar situation unfold with Tesla. While Buffett may still have reservations about Tesla's CEO and the fiercely competitive EV market, the undeniable influence of Tesla's technological innovations could eventually sway him. A modest stake in Tesla might give Buffett the flexibility to adjust his portfolio as the market shifts, allowing him to hedge against potential risks while still taking advantage of Tesla's growth. As we look ahead, the future of Tesla and the future of the investment world is being shaped by advancements in technology and shifting market dynamics. Whether or not Warren Buffett decides to invest in Tesla, his deliberations offer us a fascinating glimpse into the thought processes that could define the future of investing. The world of finance is constantly changing, and Tesla, with its bold innovations, is undoubtedly at the center of this transformation.